Hello, everyone. Hello, great people. And you are welcome to TechBiz series. Extremely excited and happy to have you here on this learning adventure. Like I said earlier, I can see people who have consistently joined us Thursday after Thursday on this learning journey. And it's great to see you all again. You know, somebody said we are all in the same storm, but we are in different boats. And that is indeed true for today because COVID is a storm. It's a storm that we're all in, but we have different boats as entrepreneurs and as business owners. Some of us have huge yachts that is riding the storm, and some have really small boats, and somehow we're feeling like we're about to sink. But in real terms, there's hope. And that is why Eco Innovation Center set up the TechBiz series to help you build, adapt, and thrive in this new reality. So hashtag TechBiz, hashtag Eco Innovation, anytime you post any message that you get from here. Quick housekeeping rules, you can type your questions into the chat box, even during the presentation, so you don't have to wait till the end, just keep typing your questions. The presentation will be for about 40 minutes, and thereafter we can take questions. If you want to ask your question verbally, that's not a problem. Just raise your hand and we will unmute you to enable you ask your question. Before we start, I'll tell you a little bit about Eco Innovation Center because people are always curious, what does the center do? The purpose for this center is to use two critical enablers. If you can move to the next slide, please. Two critical enablers of innovation and technology to contribute to solving poverty and its symptoms within the continent. Because we believe that MSMEs are the thrust of any economic growth within any country, especially Nigeria, and indeed the same is true for Africa. So Eco Innovation Center offers 4 key pillars. Learning is one, which is about training and teaching soft and hard skills to techies, to startups, and to entrepreneurs. And we're in one of that, because this also includes the TechBiz webinar series, which we're in. There's also data science school, there's media school, and there's also product incubation school, which grooms full stack product managers. On the research and sustainability side, it's about enabling civic tech, innovation that drives social impact and contributes to the achievement of SDGs. But we're also gurus in commercialization. That's what we really do. We accelerate startup businesses that already have MVPs, minimum viable products, including growth strategy, funding strategy, marketing strategy, you name it. So I'm sure, you definitely want to connect with Eco Innovation Center after this. So you can see the email there. It's info@ecoinnovationhub.com. Please move to the next slide. We go straight into what today is about: leveraging private equity and venture capital for acceleration. I'm extremely happy to have Babajide, my long time friend and brother. He is an accomplished strategic business leader, an award-winning chief financial officer. He's had over 2 decades experience in audit, in treasury management, financial management, strategic business reporting, taxation, budgeting, and administration, and also enhanced with governance, commercial acumen, as well as decision-making at the very board level, so at the C-suite at the very top. His career achievements are plenty, including recognitions. His fellowships of ACCA in the UK, CITN, Chartered Institute of Taxation, ICANN, Institute of Directors, Nigeria. He's a fellow of all of this. So we really have an expert who's coming on the board today to have this discussion with us. And who better to discuss this, because he's had the hands-on experience. In 2018, he was seconded from Man Capital. That's a UK private equity firm of Mansour Group. Mansour Group is the owner of Mantrack Nigeria. So he was previously CFO there, and he was seconded to the UK to help in their joint acquisition of EchoScan Services Limited. That's a medical diagnostic company through a Mauritius company with Egyptian Integrated Diagnostics Holding, listed on the London Stock Exchange. So, of course, you can see a web of global players coming together and really driving the part of private equity focus in that space. Babajide is passionate about developing people, and those on the call who know him, they know he's a trainer. He facilitates the ICANN MCP, IFRS, and IPSA certifications for both ICANN and ACCA. He's also a regular speaker at ACCA CPD events. If you follow him on social media, you'd see he's very busy on ACCA locally and internationally as well. He's the present secretary of the trustees of IFRS experts in Nigeria. He's a board member of ICANN Financial Reporting Faculty and chairman of Nigeria at ACCA International Assembly in UK. And he has worked in several multinational companies, including First Bank, including Nestle Nigeria, where Babajide and I worked together, and also Guinness Nigeria PLC, Kakawa Discount House, which is now FBN Quest Merchant Bank. Should I continue, Babajide? We will spend the rest of the hour talking about your credits, but you have achieved a lot. That's and enough. Definitely we as Nigerians are very proud of you. So welcome. It's really lovely to have you here.
Thank you for having me. I'm glad to be here today.
Excellent. I know you have really great news for us. There's something you want to share. It's something that our participants on the call can benefit from. And if you move to the next slide, we're going to talk about the support that Babajide has happily put on the table today. As EIC, Eco Innovation Center, we've been focused on supporting entrepreneurs to success. So through the TechBiz series, we've offered our facilitators have offered hours and hours of free coaching through the platform. They've offered financial coaching to our participants, legal coaching, and just last week, there was a free training on digital marketing to CEOs and founders. So we thank all our past speakers for this, and Babajide being a real key contributor and having the knowledge of the African entrepreneurship ecosystem. He's been nominated, he's been invited to nominate for the Yale Africa Startup Review. And he wants to use today as a platform to pick part of the nominations. So he will nominate 8, is that correct, Babajide? 8 startups from this webinar that, yes?
That's right.
Okay, correct. So 8 startups from the webinar who will be featured in the Yale Africa Startup Review. And I'm suggesting that he does that at the end during the Q&A session. You would recognize, you would identify the startups who you will be nominating for that YASR. And the 8 startups, of course, you have to be a founder, a Nigerian, making an impact within the Nigerian ecosystem. You already have customers that are benefiting from your products. And then he will make that nomination and you will be part of the YASR publication. Is that clear? I'm sure that's clear for everyone. And Babajide, we now are going to go into you discussing about private equity and venture capital to drive acceleration, to drive growth of our businesses within our ecosystem.
Right. Thank you, Doja, and good evening, everyone. And thank you for coming on this platform. I hope we're all keeping safe. It's unprecedented time, as Doja mentioned before, but definitely we will all pull through. So let's keep safe. Let's observe all the safety protocols as advised by WHO and the NCDC in Nigeria, and let's ensure we're safe. We need to be able to balance life with livelihood. Today, I'll be talking more about how you can leverage venture capital and private equity firm to accelerate growth. So I slightly adjusted the topic a little bit because I want to focus really on growth. And I've seen that the bane of major businesses in this part of the world is its funding. Many people have great ideas. But funding has been a major issue, major challenges. So a successful outing this afternoon for me will be the one where we're able to take away a few points on how we can together accelerate growth and ensure that we leverage private equity firms and venture capitalists that we have around in Nigeria and in some cases abroad, to ensure that we leverage growth and we accelerate growth and we're able to make the desired need or desired changes that we want in our businesses. In finance, there is one saying in finance, which is that revenue, some people like to call it sales, revenue. I'm still the first slide, please. I will tell you when to move the slide to the next one. Right. So revenue is thank you. Revenue is vanity. That's what we say in finance. Revenue is vanity, right? Profit is sanity. Cash is reality, right? Cash or funding is the lifeblood of any business. Without profit, a business can still survive. All right. If you have cash flow, you have good cash flow. In fact, if you have profit and you don't have cash flow and your profit is not cash back, then you're likely going to have or run into trouble. You're likely to have a problem. The business can die. As a founder, most of the time, the major headache that you have is how do I source for funding on this business, on this idea that I have? And so today, a successful outing will be for us to understand the basics of raising capital and how that can be the major game changer to our businesses as startups. Next slide. Next slide. Thank you. So in this slide, I want to take you through the financing landscape to let you have an appreciation of why when you approach the bank, and I'm sure most of you must have approached a bank at one point or the other, is either they are saying we can lend to you or our rate is something that can kill your business. If you're lucky and the bank looks at your way, they might lend to you at a very exorbitant or expensive rate, particularly when they believe in you. So this afternoon, I will focus on what are those things that lenders will look out for, venture capitalists will look out for, as well as private equity firms. And why are they looking in that direction before they can let their money go? And before a lender releases money, one of the factors that the lender considers extensively is the risk that will be borne by that investor. And you see, for some seed capital, the highest you can get, because the risk on those monies are very high, the highest you can get is to get from what we call the 4 Fs. What are the 4 Fs? They are the families, friends, the founder himself, and in some cases, some fools as well can even put you money in your seed capital. Now, we also have people we call business angels. Those business angels are interested in startup businesses, and I will explain that in my subsequent slide. Then, before you get to venture capitalists, your business should have been at an early growth stage. Now, when your business is moving from that early growth stage to an established stage, then you can begin to talk to commercial bank, non-financial, for corporations like Kakawa, this kind of where I used to work before, or some companies that will come merchant banks. Equity market is also something you can access once you become an established business. Equity market is one of the branches of the market that we have in the financial or the capital market. So we have the equities market, like Nigerian Stock Exchange, and then we have the debt market, like what we have at FMDQOTC in Nigeria. Now, there are different markets for different entities, depending on the stage that the entity is in. So when you are at the early stage, there is a place to go to look for funding. When you are at a growing early growth stage in your organization, there is a particular funding that you can access. There is a fund that an established firm can access either in the commercial bank space or equity market space or in the debt market space. All of these we're going to look at in the course of our presentation today. But I will be focusing more essentially today at just private equity firm and venture capitalists. I will talk a little bit about business angels, in subsequent slides. Next slide. So on this slide, I'm talking to the different categories of investors that we have. And like I said, I want to focus on venture capitalists and private equity firm. But you see, they are coming into your business to supporting your business depending on the stage of the businesses you're in, just like I explained in my previous slide. But there are other factors they also consider, right, before they can put their investment down. Now, we have the size of your investment, the size of investment they are willing to do. Now, when I speak to investment, I'm talking about an investor's perspective. But to you, that is the funding that you require for your business. So when I talked about the size of investment, and you are looking at the type of money, the amount, the quantum of capital that you can access from those categories of investor. So when the money you need is between $10,000 to a few $1,000,000, then maybe, and you are a startup business, you have not started any revenue. That is what we mean by pre-revenue. You've not started any revenue. Then maybe you need to talk to seed investor and angel investor, and not to venture capitalists yet, right? Now, if the type of investment that they'll be looking at is not a longer term one, they are looking at a SAFE or an equity. What is a SAFE? A SAFE is an acronym for a simple agreement for future equity. So you will sign an agreement, or if you call, sometimes you call it heads of terms. You sign an heads of term with them, in which case they will have just like a memorandum of understanding between you and them, that at a point in the future of this business, you will let go some certain part of your equity to these people. And you will sign that SAFE with them today, and they will be entitled to part of your equity at a later stage. Now, the investment team here comprised of entrepreneurs, previous founders. This is one of the things that some of the co-founders of Facebook, for instance, are now doing today. Co-founders of the big technology companies that have, become so successful. Some people that have sold out of those companies. This is what they do today. The level of risk is extremely high, and there is high chance that they will lose all their money. And so you can expect that the level of governance, and I'm going to speak to that subsequently, that they want to put in place in the organization will be higher than that which is lower risk. Then the return profile. Now, when an investor wants to invest, it's not investing because it likes your face. It's investing because it's expecting some level of returns. Now, the returns that a seed angel will be expecting, typical of them will be looking at something we call 100x. What is 100x? So if they give you $10,000 today, they expect $1 million back in X number of years, maybe 10 years or 5 years, as you have agreed with them in your SAFE or your equity agreement or in your terms of heads of terms or in your any other memorandum of understandings that you had with them. So the return target is usually 100x, very high. The focus is on it cut across different firms. So the focus, and it varies from one firm to another. They will do a major investment screening for you. And so on the left-hand side of my presentation are those things that they will do and be looking out for as investor before they can put in a dime into your business. And the investment screening they will do will be based upon who is the founder of this business. They will be looking at your TAM. TAM is the total available market. What is the potential that you'll be able to take the market share that they are looking at for this kind of business. And if you are into techie business or online businesses, they will be looking at your virality. All right, they will look at number of users that you have, etc. And then I've given some example of investors that fall into those categories under that. Now, let's move to venture capitalists and private equity firm, which is a major focus today. And please, if you have any question, feel free to put it in the chat box. I'm happy to take the question as we go, or I wait till the end, as the case might be. For venture capitalists, their major focus really is on early stages and profitability area of your business. You have not started making profit at this stage. You are still at early stages of the business. They want to come in at this point. They want to give you some few millions or tens of millions of dollars to start your business with. The type of investment they'll be looking at giving you will be equity. They want to be a part owner of the business, or they want to give you a compound instrument that we call convertible debt or a mezzanine equity. Now, what does this mean? They will give you a document where the loan, the money given to you, be given to you first and foremost in the first instance as a loan, and after some time, they are able to convert that loan to equity. That is what we call convertible debt. So they will give you a loan today. If the business is not doing well, if anything happens to the business, if the business goes into liquidation, the loan will be debentured and it will be, when I mean debenture, is that it will be secured, it will be collateralized on some of the assets of the entity. So if anything happens to the business at that early stage, then they will be the first to be paid out before any other person is paid in the business. That is why they like to give you convertible debt first, and then after some time, they can convert the convertible debt into equity. Now, who are the investment teams there? Mix of entrepreneurs, previous bankers, current bankers, finance house. They are very interested in becoming venture capital. We have quite a number of them in Nigeria today, and I'm going to explain that to you in the subsequent slides. So level of risk is very high here as well. There is a moderate chance of losing all their money, because remember, they will have convertible debt. So if at all they will lose, probably they will lose only to the extent that they cannot realize from the asset that you have used as a collateral for the investment that you have that they have made. And so most of the time they want to finance infrastructure. Most of the time they want to finance tangible assets, such that if anything happens to the business, then they can sell those tangible assets to realize their loan and get some part of their investment back. So the level of risk here is a bit moderate, all right? They are not likely going to lose all their money, and they are comfortable in terms of return profile. They are comfortable for anything in between 10x as the return target that they are looking at. So if they give you $1 million, they expect $10 million back, right? Now, and their focus is from various firms to various firms. An investment screening, they will screen the owner of the business. So you, as the owner of the business, will be screened. They will look at your market, share potential. They will look at your time. They look at your revenue. They will look at your margin. They will consider your growth rate, whether there is opportunity for you to grow within the industry that you have chosen for them. These are also a classical examples that I've given on the slide of entities that are into venture capitalists, across the globe. Now, private equity, their own stage of business is mid to later stage. Like I said, it's not every company that can access the capital market for now. I know, because you are not yet in that space where you can go to the capital market. You are not yet a large established organization. You probably are talking to a venture capitalist or a private equity at this point. And that is why our focus on that today will be on venture capitalists and private equity firms. The size of investment varies, in this category of investment. And of course, you can see the rest of the slide on how I have, categorized what and what we need in terms of scaling, and the rest of how they will look at you and investment they will do at the number of X, a number of times they will expect the investment to come back. So how does private investment class, right? And so they are not listed. When I say listed, it means they are not quoted on a capital market like Nigerian Stock Exchange. They are just group of limited partners coming together. They are investors essentially coming together to ensure that they provide access to capital, and they do their investment on a block basis, on a fund by fund basis. That is why they are called private equity firm. So they comprise of public pension fund, the corporate pension firm, insurance companies, and some high net worth individuals can also join them. Family offices, endowment, foundations, different sovereign wealth fund can also join these private equity firms. And in some cases, we have seen IFC joining some of the private equity firms to make some certain investment in their interest area. The ownership of the fund they will form a particular fund. So if you are into infrastructure development, there's a private equity fund that you go to, all right? And if they have a fund for you at that particular point in time, and they have done your RAC, we call it risk asset acceptance criteria, and some other investment fundamentals that they're looking at. Having you obtained your IM, there's something we call IM again, information memorandum, that you have to give to them, which is highly confidential information about your business. They will take all of that into consideration, and they will put you into different investments. So I have put 3 major investments in this category. So you see investment 1, investment 2, investment 3. A private equity firm will have those funds. They are usually large deal, and they are very, very big money, but they are not available in a public quoted entity. Private entities, private equity firms raise money from individuals, high net worth individuals, wealthy companies. They invest that money in buying and selling businesses. So they are not buying you as a person. They're not buying your idea. They are buying the business away from you. And when they buy the business away from you, they want you to be part of whatever they are doing. So in most cases, they will not fire the CEO. You will still remain the CEO. You'll be an integral part of the business. And so what people don't realize is when you then have people like private equity firm running the show with you, then it gives you a better view, a better perspective, better governance structure. And because of their experience in managing various kind of entities, they can then add value to you. But in this part of the world, we tend to want to prefer to have 100% of nothing as opposed to 10% of something. And so what the private equity firm would insist they want to get in most time will be control. But there is a way you can also structure the deal so that you can have some super voting power apart from your percentage of shareholders. If I give an example of Google, for instance, the founders of Google had only 14% of Google today. Now think about Google as big as it is today. 14% is a humongous amount of dollar, all right? But not only do they have 14% of Google, they also have what we call 56% of super voting shares. So as a super voting share you can have. So even if they insist they want 90% of the company, then you give them the 90% of the company and take your 10% and take a controlling super voting power. In which case, when you are voting as to what decision to be taken, what investment choices to be made, which area of business you want to branch into, what expansion plan do you have, then you have a say. But they want to see through how, because don't forget, what they want is how is my money coming back? Don't forget again, they're also representing other investors. They are not the only one who has contributed money into the fund. That is why it's a pool of fund. And it is from that pool of fund that they're going to give you money. So they also have accountability to other people with respect to the fund from where they are disbursing money to you. So you need to understand that. So when they ask for a controlling interest, or when they ask for a certain percentage of the business in terms of equity, feel free and make sure that you have a good deal with them. And of course, they are not out to cheat you. They're also interested in the company's survival. And I can assure you, they are just the best guy to deal with. Next slide.
Actually, just a second. So one of the questions that we had prior, right? And I'm assuming that that individual probably has maybe lost some level of control, if not all, of his company to private equity is, how do you then ensure in all of this that when you are in a discussion with a private equity firm and there are big demands that you feel uncomfortable with, maybe you are feeling like you're going to lose complete control, what do you do?
So thank you very much for that question, Doja. You really don't have to be under pressure when you are dealing with these guys, right? If you're not comfortable with anything they have brought to the table, just say no. Then walk away. Walk away, final answer. Yes, walk away. Another investor will come. And think about what happened to Mark Zuckerberg when he started Facebook. He was just 19 years old. 4 months into the line, somebody offered him $10 million US. He walked away from it. And from that time till now, many people have come back. The same company came back again like a year after, offering him from $10 million. Just in 1 year, they offered $75 million US. Oh, wow. He walked away from it. Right. So again, some people came again. Yahoo came, about 2 or 3 years afterward, offered him $1 billion US. $1 billion US. He walked away from it. Today, Facebook is worth $370 billion US. So if you took away 1 billion, it wouldn't have 370 billion. So think about it in that way. So if they give you any offer that is not comfortable for you, or you're not just down with it, just walk away. Just keep doing what you're doing. Just keep pushing. Of course, you get the right kind of investor. And they are just everywhere. And let me be frank with you, there is so much money. Even this COVID has now exposed investors. There's so much money everywhere now. Interest rate everywhere in the world is, if you're lucky, you get 0.5, right? But so if you are an investor with a startup, whatever you're doing, just make sure that you have an idea that would stand the test of time. And I'll give you what you need to do to put your book, to put your house in order. I call it housekeeping, putting your house in order. Once you're able to put your house in order and they can see through, what they are looking for is your cash flow. They're not looking at your profitability at this level. Don't forget, they are experienced people. They know you are just a startup. So they are not expecting you to have profitability just yet. But they want to see through end to end of your business. They want to see whether you understand what you're talking about. They want to see whether you actually are dreaming big. All right. And there are so many other things they are looking at, and that we're
And
going
you
to talk
talked about good governance as well.
Absolutely. We're going to talk about that in my subsequent slide as well. So just like I mentioned earlier, venture capitalists are a bit different from private equity firms. So thank you. I hope I've answered that question, Doja.
Yes, you have. Thank you so much.
Yeah. So now the venture capitalists on their own, they're slightly different from a private equity firm, right? Their own money is usually not long-term money. The idea is they want to invest in your balance sheet. They want to invest in your infrastructure. And the objective is clear from day one. I want to buy part of this business and exit very quickly. So usually the shelf life is usually between 2 to 3 to 5 years, right? So they just want to give you money and probably want to sell quickly. They want to give you money now and buy a stake in your business. Maybe they want to give you money today and get like 51 or 60%. And after some time, they sell 40% or 30% or all of those interests they want to sell and realize their money. That is how they operate. And they're operating in that way because they are a group of private investors. All right. And they are not, it is not just their money that is in there. There are four main players in a venture capitalist business: the entrepreneur who needs the fund, the investor who wants high return, the investment banker who needs companies to sell, as well as the venture capitalist himself who make money for themselves by making the market. We call them market maker. So if I'm a venture capitalist, I'll be working directly with investment bankers and other investors who want high return on their investment. So I will be the midwife in between them and you. All right. So we all pull all those resources together and give the money to you. And the objective of everybody is clear from day one. We are not here for the long haul. We are here for just short-term money. And we want to sell quickly at some point, exit, and make our money and move on to the next venture. That's why they are called, venture capitalists. So money that they have, the technical expertise, the managerial expertise that they have, they put it in you as a startup. And before they put that money in you, one thing they are looking out for is whether you have long-term growth potential. Once they see that your term and your growth potential and your possibility to increase market share in quick time, then they quickly make that investment before you think about it. Next slide. Next slide, please. So this is the funding in private equity capital. I tried to explain this earlier on. So if you look at it, you have on the left-hand side of the figure, of the diagram, you have investors limited, we call them LPs. You have the corporate pension fund, public pension fund, endowment, foundation, sovereign wealth. All of them put all those money in PE firm or LBO fund. LBO fund is what we call, LBO is leverage buyout. So what's a leverage buyout? A leverage buyout is a way of raising debt equity to fund acquisition. So people, instead of putting capital, they use debt. There are two types of capital. So we have share capital, we have debt capital. If somebody has share capital in your company, that person is able to have some voting power. Some person is called a shareholder or an equities holder. But if it is LBO, they have no business in your interest or equity interest or voting right. They just want to put that debt money in you. They are not even going to give you collateralized or any other compound instrument like the convertible instrument that I mentioned earlier on. They'll just give you debt outrightly, and they want their interest paid. And at the time that they are ready to leave, they just exit the market at the number of X that they want to exit, right? So that is how it happens. And they also fund startups, they fund early stages or later stages, private company, but they are looking for what potential do you have, and they want to be able to see from start to finish. They want to see end to end how cash will come into the organization. Next slide. Next slide, please. So for those who want to do investment in your company, private equity firm or venture capitalist, what they are looking at, the calculation they are doing, don't worry about this, all these mathematical or arithmetical equations that I put in there, but just think about it in terms of A, L, O, A, and E, right? So I put A and L on the top. So when they are coming to you, they will ask for your financial statement. In that financial statement, they will put your asset and liability on top. So A stands for asset, liability stands for, health stands for liability. And then OA are your operating assets. There are different kind of assets that you're using to run the business as it were. Then they have E. E is equity. So in the balance sheet that they are looking at, they want to see the total asset that you have. They want to take away your total liability from it and see what equity you have left. That equity is what they would look at today to determine what we call enterprise value in the year that they are exiting the business. So when they are looking at you as a business, this equation that I put on the screen is on their mind. And they are looking at that as they are talking to you, and they are looking at, whether you are able to meet that desired target, exit amount that will meet the owners, the fund owners, investment requirement. So everybody has a need. Everybody has an incentive. And those incentives have been aligned somehow by the private equity firm before they put the money in your company. So when they are looking at investing in your entity, they have this equation on their mind and looking at the enterprise value that they are going to be exiting with at a future date. If you're able to meet that and they can see through what they are going to invest in, either in the short term, you remember what I said about short term the other time with venture capitalists, or long term. Most private equity firms can still save for a long time, then they will do the investment in your entity. So that is what this equation is all about. And I'm happy to take your question if there's any question at this point. If there are no questions, I can go to the next slide.
You can go to the next slide. So we have questions already in the group chat, but we would rather you go through your content, because usually you would have answered some through the content already. If you go through, and then we will take all the questions that have been asked.
Thank you. So Daja asked me a question earlier on around when you were not comfortable with what they're being offered, right? Now, what you need to define value for yourself as an investor. I've explained to you, you're already in business, you know your game, you put your house in order, you have governance structure. I'm going to speak to that subsequently. Then they want to come to you with a value. The reason why Zuckerberg was saying no to all those investors that were coming at this different time was he has spoken to somebody and he already knows the value that he has intrinsic in that business, and he wasn't just going to let go because they have not reached 1/10, 1/100 of the value he was looking for in the business, right? And everybody's got a price. So if the amount they are willing to pay you at that point in time does not align with your value, then, like I said earlier, walk away. But what is value to you? Is the value in share price? Is it value in share price you're looking at, or the value of the entity, or the potential for the entity to begin to continue to earn for the future period? So the value in your business, you can use 3 major engineering to drive those values. I call them financial engineering, operational engineering, or the governance engineering. What are those 3 things? Consider a firm T. Let's say the firm is firm T. Maybe you are, Toyota company, or firm Tenny, or firm anything for T. Now, the potential target of a private equity buyout, all right, if the value of T represents the value of the firm under the status quo management, all right, and value of T asterisk represent the value of firm T under management that will maximize value, what do you think will happen? The value that will maximize value will give you more return than the status quo. And so if you take that value to be you today, that is the value of T. And the value of T asterisk is the value that you think will maximize value for you when those other new management people come to join you, and you see the value that they bring to the table that can drive the future growth of the organization to where you want it to be, then you should go for that investment. What am I saying in simple terms? Today, I currently run the business on my own. I have maybe the technical know-how alone, but I've got some people with management expertise coming to join me. Now, I should look more around that value they are bringing to the table, beyond the value that I had. such that we can have a bigger organization tomorrow. So what you look out for is not your value today, but value tomorrow. And that tomorrow can be 5 years, it can be 10 years, but you have to design it. How do you define that value? You define and design the value by ensuring that you have appropriate business model. Some people like to call it business plan. Whether you call it business plan or feasibility study or business model, you will not be wrong. But at the end of the day, people want to see that you are clear in your mind. You have dreamt, and it's a big dream you have dreamed about. And that dream, you can see it coming through, and you can put a timeline along which you expect those dreams to come through, and they're ready to put in their money, to push that dream to reality. Next slide.
Do you have special people who help in that calculation of the future earnings or future value?
Absolutely, absolutely. So those who are interested can just get across to me. I have some organization that basically what they do is just to help you calculate your value as an organization. And so when you are going into a deal, you don't go there blindly to say, somebody gives you 100 million and you just jump at it to say 100 million is a lot of money. The business might be worth billions of, instead of taking 100 million, can be worth hundreds of billions. So you have to look at the value of the business as a whole. Value of the business that you're looking at shouldn't be value of the business today, or value of the business in the future. And when you look at the competence of those who are going to join you, and I'll give an example of that. And when we're trying to acquire a target in Nigeria in the diagnostic space, we had we zeroed in on 3 major target companies in Nigeria to buy. And we saw one of them that we were really, really interested in. But just some few days before we approached the owners, another investor came and bought them. Right? I won't name names. Another investor came and bought them. Now we were then, left with 2 other ones. But when we looked at the governance structure at this other one, because the entity I used to work for was quoted on London Stock Exchange, there are so many ethical issues and governance issues they can't deal with, being a company that is quoted on London Stock Exchange. And because this other very small, diagnostic business had what we think we can shape and remodel to fit for the purpose of our listing on London Stock Exchange, we have to go for the smaller one. So sometimes a lot of factors play in, deciding where to put money, which is why my advice, when I started was to say, please dream, if you have to dream at all, dream very big, and make sure you put your house in order. When I say put your house in order, I mean put your finance house in order, and ensure you have a good governance structure. Governance actually creates value. So if you look at my current slide, you see that in the value creation pie, governance takes about 61%. This is what a typical investor is looking at. All right. So this particular investor is looking at this as a value creation. Everybody has, their definition of what they call value before they put down their money for investment. 61% is huge, and governance for them is everything. Once the governance is put in place and the governance structure is strong enough, and the entity has a good corporate governance practice and is actually practicing what it preaches, and there are parameters that are yardstick to measure whether you're doing what you're preaching or you're just putting in the piece of paper. When none of that is valued and is confirmed, then they are very much ready to dole out the cash. Next slide. So there are different sources of this value. There are different sources they can come from, and that's what I spoke to earlier on. They can come from your operations, and so they're going to do your operational engineering to find out whether there are value in your operation. They are going to come from your financial statement. All right, we're going to look at the financial statement. Accounting is the language of business. So the financial statement that you presented to them, there might be some facts, that speaks to that financial statement. But there are other qualitative characteristics that will be considered, like the integrity of the numbers you prepare, whether it's an audited number or unaudited account. There are so many other things, other parameters they will look at. They will tear the entire financial statement to look at what's your current revenue. They will look at your EBITDA. Another thing we use, to measure how a company is doing is earnings before interest and taxes and depreciation and amortization. It's called EBITDA for short. And you look at your EBITDA today, that EBITDA is more or less a little bit above your operational earnings. So we look at that operational profit. We also look at governance. Governance engineering refers to changes that might align various consistent who might otherwise have conflict. So how do you ensure you manage things like conflict of interest in the organization? How do you ensure that you have proper governance structure in place? Who reports to who? You have a proper organizational structure. Do you run the business, even though a startup or a smaller company or early stages company, as though it's a world-class organization? All of this goes to play a very big role in determining the value that you can create as an entity, right? And I think, I don't know whether that's the next slide. Can you go on to the next one? Next slide, please. Yes, so that's my next slide. And before I conclude, and my conclusion is, I'm going to use an old saying for my conclusion. And the old saying is, when you want advice, ask for money. When you want money, ask for advice. And I will say to you that no matter where you're from, your dreams are valid. It does not matter whether you're a Nigerian or whether you're a Ghanaian or whether you're a Pakistani or whether you're an American. Your dreams are valid. So, and if you have to dream at all, please dream big. But if fund is a challenge to your dream, then you have venture capitalists to speak to. There are private equity firms around that can help you. In different countries of the world, they have these people around. In America, for instance, they are on Sand Hill Road in California. They funded most of the startup tech companies and all of the big five that you then have today in the technology world at one time or the other as part of this Sand Hill investor. They are a major catalyst to economic growth in every environment. And we have them also in Nigeria. But the truth of the matter is that they will just not throw the money at you. There are some certain parameters that they are looking at. And one of those is that you put your house in order. And when I say your house, I mean your financial house in order. Have a proper business plan. Know the type of investor you should talk to, whether you should be talking to a VC or a seed or angel investor or a private equity firm. If you are not that big, maybe you shouldn't be talking to a private equity firm. Their requirements are a bit more stringent. If you are talking to a venture capitalist, know fully well that they are not going to be there with you forever. They just want to come in for a while. They have come in at a particular X. They would like to exit at some point. So you factor all of that into the negotiation that they are bringing to the table. The period that they are with you, they must have also added value. And those values must be paid for as well. And thank you for listening. And I'm
Thank
ready
you so much. Thank you very, very much, Babajide. That's a lot of meat. And I can see in the chat group, everybody is asking for the slides. I can assure you all that the slides will be shared at the end of the webinar. And even if you are not registered, the slides will be available on the website, EcoEyeCenter/webinar. The slides will be there for download. Now we have a lot of questions already in the chat box. And at this point, I would say if you want to ask your question verbally, please raise your hand. Some hands are raised, but I will go first. It's a first in, first out, FIFO arrangement here. So what's your take on crowdfunding as a source of funding while considering the proposed rules by SEC?
Well, whether crowdfunding is available for a startup is also another thing we need to consider, right? My focus today is on startups and how they can access venture capitalists and private equity firms. However, crowdfunding is also a good source of getting money, but it depends on where the money resides at the end of the day. Whether you then have enough to be able to access that crowdfunding wherever it is residing is another conversation. So for that person, I would like to take this our question offline and show you how that new SEC regulation can also help you in a way to access funding. But anything that has to do with SEC, remember, SEC regulates the Nigerian stock market. And Nigerian stock market is a market to raise, capital for big entities that meet listing requirements. So for a startup, you might not be able to access Nigerian stock market, if you know what I mean. But there are ways you can also access some other crowdfunding, and I'm happy to take that offline with the person who
Okay.
asked it.
So Lekon Igunjobi, you can see Barajide's email on the screen, so you can send him a note. Someone is asking about if you have any examples from Cameroon or maybe even the rest of West Africa, because this individual is participating from Cameroon and is interested in funding.
Good thing, venture capitalists are everywhere in the world and they are not country specific. Today, for instance, I have about 3 private equity firms. Like the one I said I was interested in, it was made up of one private equity firm in London, another company in Egypt, another one from the US coming together to put those funds together to invest in a diagnostic business in Nigeria. So regardless of wherever you are in Africa, the truth of the matter is today, Africa is the next investment destination. It is still here you can get as high as double-digit interest rate in the whole of the world. This continent is an investment destination. So wherever you are, once you have what it takes, I can give you some, in my slide when I can share with the organizer some of the, these sandhill investors or any other investor for that matter that you can approach when you need such funding. So they don't need to be based in Cameroon. There is a way they can structure the fund to meet you where you are once you have what they are looking for.
This is a very, very long question, so be prepared, and it's about intellectual property. So it's almost like a case study. A startup business could have done a lot of things to grow and gain prominence. For instance, they could have developed an idea or ideas. So they have an idea, they have ideas, they've patented them, copyrights, and they have IP to the idea, not yet a business. So how can they convert this idea into a viable, economically to show as an item under the asset section of the balance sheet?
So intellectual property, you want to convert them as an asset under your PPT.
Correct.
So incidentally, I'm an accountant, and so I know that there is a standard that we have in accounting. It's called IS 38, intangible assets. That standard defines an intangible asset as an identifiable non-monetary asset that can generate cash flow, that is capable of giving you inflow of cash. So it must be identifiable, non-monetary asset without physical substance. So in intellectual property, even when you have patented it already, it will be difficult unless you can value it, you can place a value on it before you can put it into.
Are they valuers? Are they valuers of such?
They are valuers, but the standard for recognition of an asset, by accountant, has given some rules that must be followed before you can capitalize such on your balance sheet. So it has to be probable of economic benefit. You must have intention to sell it. You must have resources to complete that asset. The project must be technically feasible, and the expenditure you will incur on it must be capable of being measured reliably. So you can't just say because you have an intellectual property and then you put it on the balance sheet. But if you have a brand name that you can measure, then you can put that on your balance sheet. If you have a franchise that you can measure, so Nestle, for instance, Nestle is a big brand, right? So Nestle water brand, for instance, is a big brand. Maggi is a big brand. And there are so many, many brands like Guinness and big brands in the world that you can think of. Those big brands that you can value, that are capable of being measured reliably, you can put them in your financial statement. But at the intellectual property level, particularly in Nigeria, where we're not so strong on intellectual property, it will be difficult if those criteria are not met before you can put them on financial statement. And like I said earlier on, I'm happy for us to have conversation beyond this session on what can come in and what cannot come into financial statement, particularly on balance sheet. Thank you.
Thank you. So I'm unmuting God's Will Kalu right now, so he can ask his question. Okay, so while that is going on, let me still go into the chat box and see. Someone asked about venture capitalists, right, and the kind of businesses that they're attracted to, that it seems like they're only attracted to tech businesses. Is that true? And if I'm not a tech business, how can I access VC?
So, yeah, it's just, maybe I should say that tech businesses are today, they're like uh, the major businesses you can see around. And that's where innovations are coming in, and people are seeing a lot of innovative products coming from the tech space, right? But it doesn't mean that, you see, technology is an enabler, first and
Mm.
foremost. So there must be a business idea behind, the technology is enabling something. So the business is what venture capitalists and private equity firms are looking at, not the technology in itself, because the technology is just an enabler. So if the business is bankable, if the business makes sense, makes economic sense, and they have done it, there's something we call discounted cash flow techniques that we have used to determine, in terms of a forecast, you just forecast how much revenue will come. Remember what I said earlier, every investor, even you, all right, if you want to put your 1,000 naira down on a business, your major focus will be, where will this money come from? If you are putting down money and you don't know where the money will come from at the end of the day, you rather not leave the 1,000 naira, no matter how little you think it is. So every investor is looking at, what is the business model that you have? What is your business plan that you have? Do you have a forecast? That's why I spoke to you putting your financial house in order. So you have to think of the idea you have. You have to put it in a numerate, in a form that people can see the number that it can bring to the table. See, in God we trust. Everybody must come with data. All right, we believe God can make it happen, but we want to see the data. So if you say, I have an idea, this idea can bring 20 billion in 1 year, we hear you. It's a dream. And like I said before, if you can dream at all, dream big. And it is free. And your dream is no respecter of your color. It doesn't matter where you are coming from, your dreams are valid. But yes, we have had all of that. Still bring it, put it down. All right, let's see the numbers. All right, once you come with the numbers and we can see the model, how the monies will come back, and we see the cash flow, it doesn't have to be at profit at this startup level. So whatever business you have, and there are a lot of them in Nigeria. So it is not true to say it is only tech. I know about a lot of private equity firms in Nigeria today. They are financing infrastructure from power to utility to any other thing you can think of. So it's not just tech, it's not just techie business that is being funded. It's just that we have many of them showing interest in technology businesses. All right. But don't forget also that technology is not a business, it's an enabler. So whatever you're doing, if you think of Airbnb, yes, there's a technology around it, but it's it's a hospitality business. Right. If you think of even Uber and Taxify, right? They are transportation business, and people see through what the business will be. They see how the business model will work. They see the model. They see how the human being comes to play. The technology is just an enabler of that process. So don't look at it as if everything is technology. There is a business behind that technology, and it is that business that a private equity firm or venture capitalists are looking at. Thank you.
See what? You have the floor. Okay, you're muted. Now he's muted again. Oh la la. Okay, you know what? Oh yeah.
Can you hear me, ma?
Finally, yes, we can.
Okay, so my name is Stuart Ezekiel. I'm actually co-founder of a tech hub here in Port Harcourt. I'm the team lead here. And there's a client we're building a product for. And we have an in-house product we're also building. And we are just right now, we're just fixing up some corrections from our beta testing. So we're almost like 95% done with our MVP. This particular client got to know about this in-house product we're building one of the days he came to the office, and we got talking and we discussed about the investment I'll be pursuing in the coming days, and he got so interested in putting in money. We discussed about the percentage and stuff like that. So here's my question. The in-house product we're building, the tech product we're building is such that in the next 6 months, we're hoping to duplicate it for some African countries. So my question now to Mr. Jide is, how am I going to play around it? Am I supposed to give him shares for the whole of the product, so no matter where we expand to. So just think about it like a co-innovation. So let's say we have a co-innovation Nigeria, a co-innovation Ghana, a co-innovation South Africa. So what am I supposed to do now? Am I supposed to just open up like, yeah, whatever we go, or I'm supposed to say, yeah, you're investing in Nigeria? We've discussed so much. We have the super voting power of about 63%. Like we've sorted that. We have a 4-year financial forecast, our growth strategy, our marketing strategy, sales, customer acquisition, and stuff like that. Digital marketing strategy, all those documents are there. But right now, I'm stuck. I'm having a product review meeting with the team tomorrow in the office again, and I know this is going to pop up. So it's more like, what am I supposed to do? Am I supposed to give him up that and just say, you're in a co-innovation as an example, or he's investing in for that of Nigeria, and then when we're setting up for duplicating it for some other African countries and all that. Then finally, again, I want to also ask for the venture capitalists. I would really plead if you can help us explain when you say it is only for the businesses that have achieved a certain level of growth and all that. Is it possible that you have a product and maybe you do your due diligence? Can you still give them a shot to see? And if that's true, can we get at least some list of such investors so that we can try that? Thank you so much, Ma. Thank you.
Right. Yes, maybe I should go with your second question first. There are quite a number of venture capitalists and PE around. And like I said, they are looking to buy the entity, the business. That's what they are looking to buy, not the product. All right. And to your first question, I will say this is entirely up to you at this stage. I don't know whether the people you are dealing with are VCs or PE, but again, it's up to you to tell them the actual one you want them to invest in today, whether you want them to invest in Nigeria now or you want them to have a stake of the entire business spectrum. So it is really entirely up to you. And then when you are in negotiation, the more you have the super voting power. And that I took that away from you as being a smart move. So when they put investment in that business, you're going to be driving some of the investment decision and some of the operational decision of the entity without necessarily having a recourse to them in some of these decisions you're taking because of the kind of super voting power that you have. So, but in terms of what to give out to them, that I would say is entirely up to you. All right. But you have to be smart in that negotiation. You have to be sure that you have done your numbers. I don't know whether they are VC or PE firms or whether they are angel investor or seed investor, whatever it is they are, make sure that on that negotiation table, you come with fact. Like I said before, in God we trust, everybody must come with facts. So you need to show them the fact of what you want to give out and why. And like I said, it's entirely up to you.
Thanks, Babajide. I'm right now unmuting Imisiolua to ask a question. Missy, please accept the request to unmute. I don't know why it's been a bit complex this evening, but normally it works properly. But while we're waiting, I will take some of the questions in the chat box. How about debt funding without equity? How can we access that?
So it's the same channel, right? It's the same investors that can come. Remember when I was explaining PE the other time, and even VC, some of them are LBO, which are leveraged buyouts that you can also access. So at the point of negotiation, you are the one that will tell them the kind of what. So everybody will come to the table to say, this is what we want. It's not left for you to seek appropriate advice. To say, given the nature of your business, given your business model, given the trajectory and how you have, seen your traction of the business since you started till now, and your vision as a leader, as the owner of the business, where you see the business going in the next couple of years, then you can accept whether it is debt or capital. At some point, when you grow to a particular point, you can do an IPO. An IPO is an initial public offer. The likes of Facebook and Google and Amazon, they all were at some point or the other talking to Sandil investor that I spoke to you about earlier on. So when they get to a point when those guys exited, they felt they have grown and became big enough to be able to do an IPO, and today they are quoted on London Stock Exchange, on New York Stock Exchange, everywhere in the world. You can see all these big companies quoted, right? So, but they didn't just wake up and get quoted just like that. But there have been some processes. So this is like your own baby steps to the point where you start running, and then to the point where you start flying. Thank you.
I would also like, if when you're giving the examples, some local companies would be nice if we have examples of local companies that we know that have accessed these funds. But in the meantime, let's take the Emisi.
I don't want to do free advertising.
Free publicity. Emisi Oluwa, please go ahead.
If you allow me, then I will do that.
My question is, can we get addresses of consultants that can help us put our financial house in on-out venture capitalists? Thank you.
Right, there are quite a number of them, and I'm happy to share with the organizers, and they will reach out to you, or you reach out to them. I'll sure give it to them after this presentation, and you can reach out to them for the list. There are quite a number of them around. We have what we call the Big Four in Nigeria. The Big Four are Otto Anderson, formerly Otto Anderson, now KPMG, PwC. We have Ernst & Young, and we have Deloitte, but they are quite expensive for a startup. But we also have some other, local ones, and some other not so local that you can also, talk to. And there are quite a number of few individuals as well who can do that for you. So I will give a list to the organizers, and after the program, you can reach out. Thank you.
There's someone in the chat box who says, Lekon Egunjobi can assist in financials. So go into the chat box and you can talk to him as well.
Very well. I'm sure Lekon will do a good job, yeah.
Okay, so guys, there you go. So another question here. Could we please raise hands? It would be nice if you could ask your question by yourself, because maybe you can even elaborate a bit more, so that we go more thorough in answering your question. Chinedu is asking, you made mention of super voting powers, but in respect of Nigeria, the Companies and Allied Matters Act prohibits weighted shares, meaning that voting powers are determined by the number of shares a person has. An exception being for preference shareholders. How can we justify that with the super voting power bargaining chip?
So I hear you on Companies and Allied Matter Act, right? And you're talking about formation of a company when you deal with CAC and the rest of them. But what I'm dealing with is you already formed the company, it's a startup. The company is already formed. You already have the number of shares you have issued. Here is a different conversation from what you're referring to. I'm not a lawyer, I'm an accountant. But what I'm dealing with is the company has been formed, all right? You registered already with CAC. You have had your authorized share capital. Out of it, you've done your issued share capital and you're starting something out. But here are people coming to buy into your entity. So you're going to have something we call heads of terms. You're going to have MOU. You're going to have IM. You're going to have series of documents between you and those people. Those are internal documents between you and them that details the relationship between you and them and how it will span in terms of control that they will have in your business or otherwise. I mean, it may turn out that you don't want to give them control, depending on your negotiation power. Now, when you come back to CAC to alter the ownership structure of the business and your Form CO7, where you have the list of the director, that's a different conversation. But that has to do with regulatory issue in Nigeria. But most of these investors are not Nigerians. Some of them come through Mauritius. We have different avenues. They come through Mauritius and need to come and invest in Nigeria because they want their money to go through Mauritius to Nigeria, and they can also do it through any other you know, if you like, investment or tax haven that they want the investment to come from. So if they do all of that, it is between you and them, right? It is what you now change in your Form CO7 as director and the rest of them that must align with CAC. So this is all these documents we talked about are internal document between you and the entity that it can also form some form of DOA between you and them. DOA is delegation of authorities, and I'm able to explain that further to you maybe after the presentation. So it has nothing to do. You're not going with a foreign idea to CAC and imposing your idea on CAC. If the investors are in Nigeria, that there is a memorandum of understanding among investors that all of these voting powers and the rest of them will be put into consideration.
Okay, so I'm going to take one more question. It's about size, okay? If you could speak more on how a startup that cannot afford the full complement of staff, how can they put internationally accepted corporate governance structure in place?
Okay, so first and foremost, corporate governance is not about staff. Corporate governance is how companies are directed and controlled. So it's about the board, the governance structure that you put in place on the board of the entity. And when I say that, I mean on yourself as a founder and people that you have some co-founders and accountability that you have at that level to ensure that as the leader of the business, you are working and only working for the benefit of the business and other stakeholders, not just the owners of the business alone. So whether you have staff, you know, full complement of staff, or you have just outsourced entities that are doing what your staff should be doing, because I know some entities, they don't even have one single staff. All of their activities and functions are outsourced. And so what the owners do, again, like I said earlier on, is to use technology to enable the business while they focus on governance of the business. And that is what the foreign investors saw in them. The PC that came, the PE firms that came to acquire them all the way from Cayman Islands saw in them that these guys are serious. They have, you know, a very good governance structure in place. They have reporting responsibility, they have accountability, and they are responsible as a people. And they put that structure was what, and you know, what endeared the mind of the investor to them, and they bought over the company from them, and they give them a very large chunk of the business as well. So it's not governance, corporate governance is not necessarily about the staff of the entity, but it's about setting the tone from the top. It's about the board. It's about whether you have the appropriate committees of the board in place. It's about whether you have appropriate financial reporting, appropriate risk management framework in place, and whether you have, you know, all those control functions, you know, reports to the accountability that the board has as an organ running the business of the entity.
So it's been a really, really thorough session, and I'm so happy with your openness and transparency and willingness to give as much information and even, you know, contact post this as much as possible. It's amazing. I would ask you one question, that in everything that we have discussed now, is there something that we should know that we have not touched on?
Okay.
You know, one second before you answer the question. You know, you had said several times during this discussion that investors are looking for bankable projects, and that's the truth, right? The money is there, and Africa is the growth, definitely the growth platform for the world.
Yes.
What is it? What more should we be talking about that we have not talked about?
I think pretty much we've talked about something I put in the slide earlier. I mean, one of my slides earlier on, I think it was, I didn't say which was, the myth is that the investors are looking for good people alone and good ideas, right? But that is a myth. The reality is the investors are looking for good businesses and good industry to invest money, all right? So if it was a good idea, and there's a famous quote very famous quote that says that ideas don't come fully formed, right? So you may not even know where the idea can take you, but you have a business around that plan. And once they see that business, they see through the business end to end, they are ready to invest. We've spoken about everything that should be talked about. Business people, particularly technology or any other startup for that matter, they know their business very well, but they tend to forget something behind, which is governance. Again, governance is very, very important. It is when I see that you have proper governance structure in place that I'm going to come, use my management expertise to support that governance to be able to deliver the promised value. Don't forget that these investors are also looking for value. So if I want to bring money today to get 10x in 5 years' time, what I mean by 10 years, I want to get 10 times of my money in 10 years' time, I must be sure, I must be very clear in my mind, without any iota of doubt, that I have appropriate structure in place to, because I don't want to put my money today and tomorrow regret that I put down my money for the business. I want to be sure that I have appropriate system and policies and procedures and controls in place to ensure that the objective of the investment is achieved. That is what investors are looking for. Once they see that, they are ready to put down the money.
Brilliant. Thank you, Babajide. We are truly honored. Your knowledge is really vast, and we're quite pleased. For the team, for the entire team on the call, we want to have a quick vote. So it's time to vote. We're going to take 2 polls. They are both going to be showing on your screen right away. So please, in a few seconds, feel free to make the vote. It's very critical that we get your feedback. Also considering that this series is run consistently every week, it is important that we know what you would like to know, what you believe will help your business to help you to build your business, help your business to thrive. So please take the vote. Okay, we have 50 people who have voted. Any other one pending? Thank you, everyone, for your positive, very positive feedback. Fantastic presentation. Someone even equated it to wedding day. Thank you for the clarity in communication. Babajide, thank you. Has everyone voted, please? I'm stopping in 5 seconds. Once it's 1:30, okay, there we go. So we close the vote now. Thank you for your feedback, and we'll take that into consideration. And thank you for the attention. Thank you to my team on the call for the very smooth logistics today. Thank you so much. I'm going to leave you with something. Someone says that there are 2 rules for being successful, 2 very simple rules. On the one side, figure out exactly what you want to do. So figure it out in a plan. Babajide talked about business plan, business model. Figure it out. The second thing is to go ahead and do it. Just do it. We're learning a lot through this whole COVID-19 period. They say it's going to be with us for a while, so our learning continues, learning never ends. But then again, we make a dream. Babajide says dreams are valid, right? No matter where we're from. So dream big. Dream big, start small. But the most important part is start. This is the time to start. This is the time to make your dreams start to happen, because 1 week or 1 year from now, you will wish you started today. So friends, stay well, stay safe, and don't forget, take action. Thank you, and have a lovely, lovely evening.
Thank you. Bye-bye.
Bye.